US02Y. I want you to click on it, and it's going to turn into that. This is the 2-year government bond. Once you do that, I want you to use my colors. I want you to click on the line. I want you to make it white. Why is it light blue? White. You make it white. Can everyone confirm on the chat that they've done that, please? Thank you. Bing bong. After you do that, I want you to click on this button again. And you're going to add another symbol, and that's going to be the US 10Y. And then you're going to click this. It's going to add it. It's going to show up here. I want you to make that line the color that I have it, purple. Is everybody with me so far? Yes, no, maybe. Good. Bing bong, you're the only one participating. I appreciate it. The next thing you're going to do is you're going to add the US 20Y. This is the 20 year. I want you to click on it, and I want you to add that as well. I want you to make sure that you have the same color that I have, which is yellow. Click on it, and you make that yellow. And after that, the last one that we're going to add, we're going to click up here again, and we're going to add the US 30 year. We're going to click on it. We're going to add it. Going to add. It's going to be somewhere parallel to the 20. Excuse me. And you're going to leave that in blue. Because I don't have labels turned on. All right. So you're going to make the 20 year blue. Why are my colors off? 20 is yellow, 30 is blue, 10 is, what's off here? 30 is blue. You know what? Why am I having a senior moment here? What's wrong here? It's white, purple, the 30 is blue. 30 is blue. Sorry about that. And the 20 is yellow. Having a senior moment. Tomorrow's my birthday. I'm 42. Leave me alone. Okay? So everybody is here and everybody has done this, correct? So we should have 4 different bonds. We should have the 2, the 10, the 20, and the 30. Yes, the 20 is trading above the 30. But we all have this exact same setup. I want you to then save this setup and save it as your bonds layout. And bonds are spelled exactly how it sounds, BONDS layout. After you do that, I want to make sure that you guys always have this, whatever you called this chart that you saved it as, right? I always want you guys to have this parallel to whatever charts you have. So in my case, I have it next to the VIX, because you guys know I watch the VIX a lot, and next to the S&P. I have this layout, minus that tab that we just created, obviously, sitting in one of my monitors that I always watch. This is something that I'm always flipping through, and you'll understand why after. I also want you to put away your watch list because you don't need it. So make sure that you save it simply so that you have it like this. Okay? And there's one more thing that we're going to add, which you won't see on any you won't see on any time frame, okay? Other than the daily, which is the Fed funds. Okay? This is where the current Fed funds rate is at. So this is always good for you guys to know. So you're going to ask me, what's the ticker symbol for that? You type exactly this. You come to your thing over here. Sorry. And you type Fed funds. It's going to be this one. And you're going to make sure that you make it the color green. And it should look like this. The only difference is that you want it to be regular, you don't want it to be percentages. So make sure that on the right-hand side, if it's all wonky, you have this set to regular. Is everyone with me so far? Everybody with me? Other than Bill Bong? Bing Bong? Okay, perfect. Hey, what's going on, B? Okay, so now this is how your chart should look. And now that you have your bond set up, you're going to leave it like that. We're going to click over here. We're going to turn off the Fed funds. And we're going to keep this on a 30-minute, or if you want, the 65-minute. Either one of these time frames is what I want you guys to have it on. I don't want you to have it on the daily. I don't want you to have it on the 4-hour. I want you guys to have it on the 30 or the 65. Okay? I'll explain why those time frames later. Now that we have this done, I'm going to close this crap because I don't need to have two of them. Close without saving. Okay? And let me just close this and let me just set this up the right way. And we're going to go to the PDF. And of course, this is going to be a lengthy explanation, so just bear with me as I begin. I'm going to get some water, 1 second. How bonds affect the stock market? A simple guide for new traders. Section 1. Remember, guys, if you need this document, it's available in announcements for you to download. What are bonds? Think of bonds like an IOU. When you buy a bond, you're basically lending money to someone or something, in this case, the government or a company, in return for them to pay you back with interest. So it's exactly the opposite of what your credit cards company do, right? In this case, you're the credit card company for the government, all right? Unlike stocks, which make you part owner of a company, bonds are more predictable. Think of them like a steady, reliable friend in your investment portfolio. Okay? Bonds are tools, or I'm sorry, are instruments that are used to generate income for traders. And the way that they generate income is by giving you an X amount of interest per X amount of dollars that are invested into a particular maturity. What's a particular maturity? A particular maturity refers to a 2-year investment, a 5-year, a 3-year, a 10-year, a 20-year, a 30-year. Yes, there are 3-year bonds, there are 5-year bonds, there are 7-year bonds, but the most common are the 2, the 10, the 20, and the 30. Okay, so remember, no, they're smaller time frame bonds, but those are called something else. But just we'll cross that bridge when we get there. Okay. So I am a company. My company's name is Bananas. And I am Bananas LLC, and I need some money. So what I'm going to do is I'm going to go to the outside of my company and issue a bond for X amount of dollars. Let's say I need $50,000, right? I'm going to say, if you loan me $50,000, I'm going to pay you 5%, okay, for 2 years. So that's how you have to think of it, right? We are going to lend money and in return, they're going to pay it back with interest. So we're giving them money so that they can give it back with interest. Okay? That's why it's referred to as an IOU. There are key bond terms that I've made very simple for you, which everybody who trades should know because it's very, very important that you know what these terms mean. Principal is exactly what it refers to. It's the amount of money you lend. The coupon rate, it's the interest you earn, which is paid usually twice a year. So it's every 6 months you collect the coupon. Yield is how much return you get based on the bond's price. Okay? So if we yield is referring to interest, okay? Maturity is when you get your money back in full. So we understand that if we have a 2-year bond, we're committing till maturity. Now, you don't necessarily have to commit till maturity, but we're going to assume that we're committing to maturity. Okay? And then duration is how much a bond's price changes when interest rates move. This down here is something that you really don't, for novice traders, you really don't have to know too much about it. But the most important thing is this: understanding maturity, understanding yield, understanding that coupon rate refers to how much money you get paid, right? For the interest you earn. And the principal refers to the money. These are the 4 most important ones. If you are using the PDF and you know how to highlight on a PDF, I have no clue how to use a fucking PDF highlighter, so I'm not even going to try it. The seesaw effect between bonds versus interest rates. Bond prices and interest rates move in opposite directions. People get extremely confused by this concept. Okay? I want you guys to understand it in the simplest of terms. Bond prices and interest rates move in opposite directions. And it's not that difficult to understand once you see this. When interest rates, oh, this is how you highlight? Oh, you highlight the text like that. No way. Oh, wow, I'm an idiot. Sorry. When interest rates rise, bond prices fall because new bonds pay higher interest rates, making old ones less attractive. When interest rates drop, bond prices go up because old bonds with higher rates become more valuable. This back and forth motion is one of the most important things to understand, right? So when you see bonds yielding high, that means that they're cheaper to buy. When they're yielding low, that means that they're cheaper. They're more expensive to purchase. Does everybody grasp that concept about how bond prices and interest rates move in opposite directions? Do we get that? A little participation goes a long way, guys. Okay. So now that we understand that bond prices and interest rates move in opposite directions, and we know that they're inversely correlated, right? Now we'll understand how bonds affect stocks. The big picture. Bonds and stocks are like 2 sides of a seesaw, constantly competing for investors' money. Changes in the bond markets can send ripple through the stock market, creating both risk and opportunity for traders. Let me explain really quickly the simplest way that I can so that you can understand. Think of bonds as a safety asset that are yielding X amount of money that are paying X amount of money on coupon in volatile markets. It's to say, if I'm an investor and I have $100 million, would I rather put my $100 million inside of the bond market where I'm guaranteed to make X amount of interest on that investment over X amount of time? Or if I have $100 million, am I going to throw them into Tesla? So bonds serve as a hedge against your equity positions in volatile times, or for that matter, as income producing instruments. Let me repeat that. Bonds function as protection because they are income producing instruments. So if we know that bonds and stocks are like two sides of a seesaw constantly competing for investor money, we then understand that there are two sides to the stock market. You have the regular equity traders, right? And by that, let's just call them equity bonds, equity futures, whatever, option traders. And then you have very smart money, or the big boys, which are the bond traders. And these are the guys that you should be looking up to, because these are the smartest guys in Wall Street. Because the bond market, if I'm not mistaken, I don't remember how many times larger it is than the stock market, but multiply it by an obscene amount. Okay? 4 ways bonds influence stocks. Investors choose between bonds and stocks. When bond yields go up, investors may move their money from stocks to safer bonds. When yields are low, stocks become more attractive. What does this mean? If I, once again, have X amount of dollars and I know that I'm going to get X amount of return from X amount of an investment, and I don't have to worry about my money, I'm going to put them in bonds because I'm getting a large return. Now, if I'm getting a low return for putting my money and buying debt, right? What's going to happen? It's not interesting for me because why would I give you 2, 3, 10, 5, $100 million to make a measly 1% return? But if you're offering me 5.25%, now that looks interesting, right? So when bond yields are higher, bonds become interesting. When bond yields are low, stocks become interesting. Okay? So we understand this concept. Borrowing costs for companies. Higher bond yields mean higher borrowing costs for companies, which can hurt profits. So if I am in need of X amount of dollars and I am promising to pay that lender 10% back, that's a lot of money that I'm paying back. So you have to take that into account on your P&L. But if I'm borrowing X amount of dollars and only paying 2%, that's not that bad, right? So sometimes companies will issue bonds because they need the money and they're paying that interest, and that can be damaging for them in the long run, right? Not always, but it can. Now, lower yields make borrowing cheaper, helping businesses grow. Obviously, right? If I don't have to pay that much interest in the money that I'm borrowing, I don't have to worry about the bottom line being not getting screwed over by having to pay so much interest on the money that I'm borrowing. Number 3, economic growth signals. Rising bond yields often mean a strong economy. Yes, that literally is what it means. When bond yields rise, it often means that there's economic growth. When and the opposite, falling yields can signal a slowdown or a recession. Okay. I want you to think about that for a second because it almost sounds kind of opposite to certain situations that we've been facing now. But when bonds are rising, it's because nobody wants to invest in them. So they're trying to attract people to invest their money into that particular market because they need the money, number one. And number two, they're willing to pay more money to get your money, right? So what happens is when there's when yields are when start to rise, that means that people are taking money out of the bond market and they're putting it into risk assets, right? So when we talk about risk assets, we talk about equity. Okay. Number four, risk appetite. High bond yields make riskier investments less attractive. It's literally what I just said, right? So if, for example, I don't know what the hell, I'm trying to think of a very volatile stock, Celsius. I don't know if Celsius is going to be up 10% or down 10% one day, right? I don't know. I just don't know. But if I get a great return on an investment into a bond yield, risky investments don't look that appealing because they're risky, even though they're high risk, high reward. But you know what? I'd rather just park my money in this high yield market because my money is going to be safer, right? The opposite concept, as I said, low yields push investors to take more risk, helping stocks rise. So when the bond market starts going down, right? When the bond market really starts to go down, you'll start to see stocks start to rise. We are not right now in an environment where, yields are pushing down and stocks are rising. We're right now in a situation where people are fleeing the equity markets and parking their money in the bond market because they're scared, right? Or they're staying into cash in their own CD accounts. Okay. But you will see that there are flashes where out of nowhere the bond market yield just starts dumping. And that means that, guess what? When it starts to dump, that means that people are pumping money into the bond market and they're taking money out of the stock market, right? So that means that you're going to see exit liquidity in a lot of undermines, right? So keep that in mind, something to monitor. Section 3, key indicators to watch. The most important thing that you're going to learn today is the yield curve. And it literally is a sneaky predictor of recession. If you guys watch CNBC, my favorite person in the world, Rick Santoli, who screams like a psychopath because he claims that the world's going to end. And if you don't know who Rick Santoli is, you know exactly, you have to know who he is. He sounds like this.
The government should spend $1 trillion an hour because we'll get 1.5 trillion back.
Love that guy. So let's explain what the yield curve is. The yield curve shows how short-term and long bond yields compare. A normal curve, long-term yields are higher than shorter-term yields. This is a good sign. An inverted curve shows short-term yields are higher than long-term. This often predicts a recession. And if we go all the way back to 2023 or 2024, I can't remember the specific date right now because I'm drawing a blank. You'll notice that everyone started talking about the inverted yield curve. Do you guys remember when we started talking about that when everyone was talking about the inverted yield curve, all that noise? Do you guys remember that episode in time? Were you guys trading back then? Okay. So for the last 50 years, every US recession has been preceded by an inverted yield curve. It literally has been the signal. And traders pay very close attention to this. They do. Now, can it take a long time for the recession to happen once the yield curve gets inverted? Absolutely. It could take a while. But this is a signal of bad things to come. And one of my favorite Wall Street traders was Marko Kolanovic, who was the head of JP Morgan, he got fired from JP Morgan for saying that the world was coming to an end. And he predicted that the S&P would have a huge 20% correction. But the problem was he was too early to the game and he lost his job. And one of the things that I've learned from my mentors, who most of you guys know who that one person in particular is that the guys that get fired in Wall Street are not the guys that are eventually right, are the ones that are wrong right now, right? So Kalanovich was correct about what was coming. He was just wrong at that moment, so he lost his job. The most important treasury bonds to track, I put here that they're the 2, the 10, and the 30, but I wanted to add the 20 onto your list. I'll explain why after. The 2-year predicts what the Fed might do next, right? The 2-year is, think of the 2-year as your buddy. He is your best friend, right? Because he's the one that's going to tell you, yo, the Fed needs to catch up to us. Are we ahead of the Fed? Are we behind the Fed? Normally, the bond market will be ahead of the Fed, right? That's the common goal. The Fed's always behind, right? The 10-year, think of that as the benchmark that affects mortgage rates and loans, right? Literally, think of that as the benchmark. Even though we're not right now, the 10-year yields less than the current prime, but you have to think of it as the benchmark. And then the 30-year reflects the economy's long-term outlook. Or so you hope, right? And then, of course, you have the 20-year, which you can kind of think of it also as it reflects the economy's long-term look. But the 20-year is kind of just almost, if the 30-year is your grandpa, think of the 20-year as your dad, and the 10-year as your big brother. All right? That's something that I learned, so keep that in mind. A key indicator is the spread between the 10 and the 2. Yes, there are spreads in the bond market, just like there are spreads on level 2s when you trade, right? If you're purchasing this, if you see on the bid, it's 425 and the ask is 450, there's a 0.25 spread on it, right? There's a 25-cent spread on it. So there are spreads in between that. The spread refers to the space between the 2 and the 10, okay? That's what we refer to as the spread. If the 10-year is lower than the 2-year yield, that is a negative spread. And it is often a warning sign that a recession could be coming within the next 6 to 18 months. Now, remember that I told you that Marko Kalanovich lost his job because he was right, but too early, right? And as we said, the guys that lose their jobs on Wall Street are not the guys that are eventually right, is the guys that are wrong right now, right? Is it important for you to understand what the spread is? In theory, it is. But right now, we're doing a crash course into the most basic of things about the bond market. We're not getting into a very advanced technical analysis of how the bond market works. Because number one, I know about the bond market because of the people that have taught me, who are Ray Pitts, who you guys that were here met him, and he was the first trader on Wall Street to make $1 million, the former head of First Boston and managing director of UBS. You guys know Tom Layton was the former head of the UBS bond department from 1980 something. He was there during the crash up to the 90s before he went to SocGen and Sumitomo. So the people that have taught me over the past years were the biggest bond guys in the market, right? But I don't have the in-depth knowledge to teach you what they could. So do we need to know about the spread? It's important to get it, but not right now. Okay? Section 4, learning from history. Recent market events. And let's talk about the most recent ones. In 2020, the Fed cut rates to near zero. Bond yields fell, stocks soared. This literally happened. In 2021, inflation picked up. Bond yields rose. Stocks faced pressure. 2022, the Fed raised rates aggressively. Both bonds and stocks dropped. And the 23-24 markets adjusted to the new reality of high rates. This is very, very important that you understand. Why is it important that you understand this particular? I feel so cool because I know how to highlight now. Swear to God. Why is this important? Because most of the people that started trading 3, 4, 5 years ago, right, were in the boom of buy, hold, buy the Qs, buy SPY, and they went to the moon. There wasn't a lot of trading that was done. Did you have ups and downs? Absolutely. But all you really had to do was just buy your position and hold because it was a bull market. And no one was really paying attention to the situation of interest rates because we were still getting 2.9% interest rates on our 30-year fix, which is obviously the 30-year mortgage. And even prior to the 2.9, which is the one that I had, people were getting 1%, 1.25%, 2%. I don't even know what it was at any given time, but people think that I'm a living legend because I have a 2.9% interest rate on my 30-year fix. Because compared to where the prime rate is right now, which is at around 725 plus points, it's about 7.5. Think about it. If you're paying 7.5% on $250,000, that's a lot of money compared to paying 2.9% or 3%, right? It's almost double. So this is where we talk about how housing is becoming unaffordable because the mortgage rates that we're paying are not sustainable versus the income that we have. Does that make any sense what I just said? Any participation would be appreciated. Okay, cool. So now that the market is adjusting to the new reality of higher rates, people have to adapt to the fact that they are going to have to live in a 6.25, 6.5, 7, 7.25, 7.5, potentially 8, 9, who knows, maybe even 10% interest rates on a 30-year fix. So what happens is we are learning to accept that the 2%, 3% rates are no more. So what we're doing now is we are accepting the new reality, right? I don't want to accept it, but it's what we're doing. And that's a very good statement. I'm served. It's learned behavior, right? Trading strategies based on bonds. We talk about sector rotation all the time. Financial stocks do well when yields rise, while tech stocks perform better when yields fall. I want you guys to grab your PDF and highlight this like me, because I'm so freaking cool because I figured out how to do that. And I want you guys to print this page and put it in front of your desk. Financial stocks do well when yields rise, while tech stocks perform better when yields fall. Defensive investing. Utilities and consumer staples can provide stability when bond yields are rising. I also want you to highlight that. Growth investing. Tech stocks and growth stocks tend to benefit when yields are dropping. Can anybody in the live sessions chat explain why growth investing benefit from yields dropping? Can anyone guess from the explanation that I had? Someone just type it out. No, Tabitha? Why do tech and growth stocks tend to benefit when yields are dropping? Yields drop, people flock to stocks, exactly. And borrowing is cheaper. But the reality is that yields drop, people put their money into risk. And I also want you to highlight this. Please, I posted this on purpose so you guys can. Buying stock ETFs while shorting bond ETFs or vice versa to profit from their relationship. This is how you hedge in a portfolio, ladies and gentlemen. When people talk about how trade pairs, this is how you protect yourself. Buying stock ETFs while shorting bond ETFs or vice versa to profit from their relationship. As an investor, as a portfolio manager, you as a portfolio manager, because you should see yourself as a portfolio manager, need to understand the correlation between stocks, bonds, and how they function. And with that being said, you need to understand how to be defensive and offensive in your portfolio. So, this is very important that you guys highlight and understand. Section 5, improving your trading skills. Hi, Bonks. I see you here. Common mistakes to avoid. Ignoring bond signals. The bond market often moves before stocks react. Yes. Misreading the yield curve. Takes practice, but it's worth understanding. Once you understand how the yield curve functions, it will give you a huge understanding and broader perspective of what trades you can take and what trades you shouldn't take. Forgetting about inflation. Real returns matter more than nominal yields. It's very important that you understand this. Real returns matter more than nominal yields. Keep that in mind. Overlooking sector effects. Some industries benefit while others struggle when bond yields change. You guys need to understand which sectors benefit from that. It's important that you guys have a broader understanding of sectors, which is something that Kevin and I had spoken about, how important it is to have your SPX sector watch list with all the spiders so that you guys can see, hey, this sector is benefiting from yields rising, this sector is benefiting from yields dropping. Questions to ask before making a trade. Where are bond yields heading based on the recent economic data? It's important to understand if bonds are going to go up or bonds are going to go down based on the data. I'm not going to put on a trade until I understand what the hell is going on. A lot of people don't pay attention to the 10-year bond auction. A lot of people don't pay attention to the 2-year bond auction. And then they're sitting there at 106, 107, 110, and suddenly there's some erratic behavior where the market completely sells off. And they're like, what happened? Oh, there was a 10-year bond auction and it was a failed auction, right? What is a yield curve telling me about recession risks? If the yield curve is telling me that there's a potential recession risk, I want to make sure that I'm not being a complete asshole. If I am getting the warning that there is a potential recession, yes, am I going to follow the trend that the current market is in? Yep, I'm going to, but I'm going to be careful because the minute I get that signal that something is coming that really feels not correct and it feels like we're very, let's just say, bubbly, I'm going to get out. Which sectors will benefit or suffer from current bond environment, right? This is important because before you place a trade, especially in an environment where right now people are talking about the bond market and look at what's happening, TLT, which a lot of people don't even know what TLT is, right? Now it's now people are like, oh, what's this whole bond stuff? What is this? It was like the same thing when the yen carry trade. Everyone was talking about it on TV, and no one knew what the yen carry was, and they thought that yen carry was a person, right? So I know Bonk is getting a good laugh out of that one because there was a bunch of people that thought that yen carry was a person. So it's important to understand that when people start talking about it on TV, by the time they're talking about it on TV, you're already late to the game. That's also very important, okay? Next steps for you. Track the 10-year daily. I'm not telling you to sit there and watch it all day, but look at what it's doing. Watch how different sectors react to the bond market. It's important, again, you guys have that watch list. You should be watching how the sectors are reacting based on those bonds. Practice paper trading during major yield shifts. I cannot tell you this enough. The reason I got so good at trading the University of Michigan sentiment is because I lost more money than probably the cost of a Kawasaki brand new motorcycle, right? Because I was trading the bond market thinking that because my mentor was a fucking genius, that I could just go into the bond market and be like, I got this shit because I'm the man. I'm the sexy Latino in Palm Beach. I got this. And I had no idea what the hell I was doing. So I had to learn the wrong way. I had to learn hard way. The reason referring to University of Michigan sentiment, how I got so good at trading that particular piece of data is because I paper traded that information. I back tested it for a long time, right? And I know exactly how to do what to do when that data comes out and how to read it. Same thing happens when you're looking at major yield shifts, right? I always tell everybody, the bond auction is at 1 o'clock. At 1:01, you get the print. You wait 10 minutes after that to see what the hell these bastards are doing. Because remember, the bond boys are the smartest guys in Wall Street. They are smarter than anybody you could ever think of. Do they have a drinking problem and cheat on their wives? Yeah, that's okay. They're bond traders. Build your personal playbook for how stocks react to bond moves, right? Very important. If you really want to learn more, I recommend that you read this book, The Bond Book. Great book, incredible book. It's a read, complicated read, but you should read it if you want to learn more about bonds. And then strategic fixed income. Believe it or not, this is a great piece of reading material, but if you really aren't a great reader and you don't really want to put yourself through this entire process, you want to know something? Go on YouTube. And on YouTube, you just type fundamentals of bond markets, and you're going to get huge videos from great people. From Investopedia has a great video. Fidelity has a great video, even though I despise Fidelity. Charles Schwab has an incredible video on how bonds work. There's a lot of good stuff. Even Ray Dalio, I believe that in his Principles book, there's a particular chapter that touches base on the importance of fixed income. 1 second. Sorry, I just had to type a message. I lost my train of thought. Websites worth checking out. Fred, you guys should be looking at Fred all the time. Fred has every single piece of information that you can think of. TradingView helps compare bonds and stocks. Guys, I showed you how to set that up. And Investopedia, my favorite website. It's easy to understand it's easy to understand bond market explanations with Investopedia. And believe it or not, that the majority of the things that we discuss, you can find them in Investopedia. And I believe that Investopedia also has little links to videos that you can watch that make it easier to understand. I'm the kind of person that I like to see videos and like the visual aspects of learning more so than just reading a book. Call me an asshole for saying I like pictures in the stuff that I read. Yeah, I'm the guy that goes to the restaurant and looks at the picture on the menu. So yeah. 1 second. Oh, that's cool. Final thoughts. Bonds can give you an edge. Most new traders focus only on stocks, but understanding how bonds move can give you an advantage. By watching bond yields, you'll spot market trends before many stock traders even notice. So now that you have the basics, I want it to be really cheesy and put something kind of like cheesy. It's time to put them into action. This concludes the introduction to the bond market and how it affects the stock market. Thank you very much. Thank you. Thank you. Thank you. I know. Incredible stuff. I know. Great. Now that Kevin is Kevin still here?
Yeah, I'm alive.
Okay, Kevin is here. I'm sure there might be some questions. I'm sure that there's a lot of people that don't understand 99% of the things that I said, which is why you have the PDF. So if you have any questions, I am more than happy to answer them. But please take into consideration that I'm trying to keep things very, 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 very simple so that everyone can understand. There's actually someone in here that I don't know if he minds being unmuted, who was actually mentored by my mentor at one point. He's also a dinosaur like me, and he's muted right now and he can't defend himself. But if Bonk, if you want, I would love for you to chime in on this subject matter because you have been around longer than I have.
He would
If you
have
don't mind.
to disconnect and connect back again.
Oh, okay. Well, Bonk, if you can leave and come back in, if you don't mind chiming in, I know that your input would be phenomenal.
But meanwhile, while we wait for that, you guys can go ahead and ask the questions you have, and JP will answer it.
So, show us how to set up TradingView one more time really quick. So, what we're going to do is we're going to come over here. We're going to create a new layout. Oh no, why does ES pop up? So depressing. So what we're going to do is we're going to come up here. Why are futures popping up? You're going to type US02Y. And it's going to be this one, the TVC. And you're going to make that the color white, just like I have it. And then you're going to click over here, and you're going to add US10Y. And that's going to be somewhere up here. And I believe that stays as purple. Yep. Then you're going to come up here, and you're going to do the US20Y. And that's going to be somewhere up here. And that's going to be yellow. And then we're going to add the US30Y. And we're going to make that blue. Mantle, does that Does that answer your question? Okay, you're welcome. So I saw someone made a comment about bond futures. I'm not going to talk about those because it's going to confuse the shit out of everybody. But you did ask, seems like volume has slowed down a ton since 2020, and it has. That is true. Compa Rick de Mexico. It has, but it's slowly starting to pick up. I don't put volume on this because the reality is that whenever you see the bond auction and whenever they talk about it, it shows you on the Fred site how many bonds were bought by dealers, indirect dealers, et cetera, and that's a completely different subject matter. Okay. I don't want to confuse anybody by letting, they don't even, if people don't even know right now what the spread on a 210 is, talking about indirect and direct bids is going to drive them nuts. But the way that you can kind of see if an auction is doing well is based on the Fred site when they publish the print, and the print gives you the core how many direct bidders came in, how many direct bidders came in, what was the bid that the Fed put in, et cetera. Okay, and that's all on the Fred site. Show me how to compare bond movements against Tesla as an example, if you would like. So, what you're basically wanting to do is you're wanting to compare bonds to a high beta stock. And I understand what you're trying to do. You're trying to see what's the correlation between bonds going down and Tesla going down. Well, I don't need to put a chart next to this to show you anything about Tesla because I can just simply ask you this. I am Serve. In the past couple of days, has Tesla stock been going up or going down? I am Serve. Okay. Would you say that the majority of the Mag 7, or in this case, what I like to call Batman, because we added Broadcom onto that, right? Batman. Would you say that the majority of them have gone down or they've gone up? Okay. So if we have an understanding that let's just say that the biggest percentage holding stocks of the S&P and the Nasdaq are going down, would you say that there is an exit of money out of this particular high beta asset class into safety? Yes or no? So, outside of investing your money into safety, right? And when we talk about safety, we talk about safe stocks, right? Like right now it's been an overall market sell-off, but like Coca-Cola, Kevin, help me out here. Safety, give me safety.
Waste management.
Utilities.
Waste management.
What else is safe?
Waste management.
Waste management. Yeah, waste management. Stuff like that.
Pepsi,
Outside of
GIS,
Johnson & Johnson, great.
Clorox.
Yeah, there you go. Outside of putting your money in that, the guys that are really, really, really have a lot of money, right? Like Kevin. I'm kidding. What they'll do is they'll take their money out of this high beta and they'll go and put X amount of millions of dollars into the bond market because I've already squeezed so much money out of Tesla, Nvidia, Google, et cetera, and Apple that I can take some profits. And what am I going to do? I'm going to park it in bonds because those millions of dollars, right, that I am making because not millions, the millions of dollars that I'm investing into the bond market, the coupon that I'm going to get paid every 6 months, I'm more than happy with it. Because let's just say that you got the top of the 10-year at, let's not even say the top, but let's just say that in the past couple of weeks, let's say that you got the 10-year at 4.6, or it doesn't even matter you got a 4, so you got a 4.4. And let's say you got $50 million. You got $50 million in the 10-year, that's yielding you about 4.4%. Let's just say 4.4, 4.3. That's a good chunk of change that you have parked in safety. And you're going to collect that 4.4 coupon every 6 months. Right? So when you start seeing all these high beta stocks or this volatile high growth risk start to go down, you can bet your ass that there's a high probability that smart money is moving their money to bonds, or for that matter, their sector rotation into safeties. This is where you start to understand the whole concept of the 60-40 portfolio or the 730 or the 50-50, which is not done anymore. And in this case now, even the 730 portfolio doesn't exist. Most firms right now, Fidelity sucks. They do the 60-40, right? Where you start to see, okay, we're moving money around. We have 40% in bonds, 60% in equity. Sometimes they'll do, 50, 40, 10 because they keep 10% cash. So if you're seeing exit out of the NAS and out of high beta, it's probably there's a high probability that the yield of the bonds are going down, which means that they are in demand, which means that the bonds are costing more money. So what people, smart money, really, 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 really smart traders want to do, let me just turn this off, is they try to find the tops of these markets, right? Of the bond market. Like for example, imagine owning the 2-year and it's yielding you 5.25. That's a huge return, man. Especially if you have millions of dollars. Now, granted, you got to be a lucky son of a bitch if you caught the 2-year at 5.25. I know a couple of people that did. So does Bonk, right? Or even if you got the 2-year at 5, right? Because think about it, you're literally lending money to get X amount of return for that loan that you're giving, right? So imagine you're over here in 2023, October 2023, and you picked up the 2-year at 5.20. Look at how much money you are yielding, you are making compared to if you would have picked up the 2-year in October of 2024. That's a huge move from there to there, right? So really, really smart guys like Tom Layton, Ray Pitts. I'm just trying to think of other guys that were genius traders back in the den. I mean, granted, Moynihan, who now runs Bank of America, was a bond trader, but I think he's upside down like $300 billion on the 10-year because I think he bought it like at all the way down here, if I'm not mistaken. They have an upside down position on the bond market. I think they own the 2-year like at 2%, or I don't remember what it was. It's some ridiculous number, but Moynihan, I don't know how he's still the head of Bank of America, right? But these are the guys that were up here were very, very smart. The guys that were even up here were really, really smart. But this is just another level of competency that unfortunately we don't have. At least I don't. Maybe a couple of people do. But if you have large lumps of money, why not park it in a 5% return? Where you're not worried about the ups and downs of the stock market. What the hell do you care if Nvidia goes up 5%, 10%, 20%, down 20, down 30? There are people that just don't want to be part of that game. They're just happy collecting interest. I sure as hell would want to be collecting interest. One of the things that I learned were like some of the biggest clients for the bond market were major companies like Ford, Aetna. You know what I mean? They were the guys that were coming in and they're like, I'll never forget the stories where Aetna would pick up the phone and apparently call UBS and say, I want $500 million of the 10. And it's like, you think about it, $500 million at the 10, and that shit's yielding you, 4.25. That's, sheesh, right? So, it's pretty cool when you think about this, and how think about how much money is in this market. You know what I mean? Think about that. Think about it. Like we're talking about if the Fed is auctioning 50 billion in bonds. Think about that number for a second. It's absurd. It's stupid money. For example, today, I believe there was. I wanna see what was the last 10-year bond auction. How much was auctioned off? Can you pull that up for me, Kevin? Can you look at it?
You want me to search a what?
How much was auctioned off on the last 10-year? What was the amount that was auctioned off?
Yeah, let me figure that out. 1 second.
You go to Treasury Direct. By the way, if you ever want to buy bonds, you can do it directly through Fidelity, or you go to Treasury Direct and you can do it. But let's see, competitor for the God. I want to
You
go to
said
the most
10-year,
recent
right?
auction. Yeah. Like what was the amount that was auctioned off?
The amount auctioned off was $39 billion.
There you go. So this is what the auction results look like. You go over here to Treasury Direct, right? And you can look at all of the latest auctions. Also, you'll see that the auctions are always on Financial Juice, and they're also on Forex Factory. Financial Juice it just tells you, every single important auction that's coming up. The auctions always take place at 1 o'clock. The important ones, the 2 and the 10, the smaller ones, those you can disregard them. But I don't think we have a bond auction this week. I think we have one next week, if I'm not mistaken. We have a 4-week bill, but nobody cares about that. That's for fucking losers. But yeah, so if you ever want to see the competitive results, you go to the Treasury Direct Gov, and you can see the upcoming auctions, and it tells you what's coming up. And for example, we have a 10-year. Oh wow! Auction date is 4/9. It's announced. Let's see how much. Oh, we don't know how much is going to be auctioned off here. But for example, we have a 10-year bond auction that's happening in a couple of days. But yeah, here's an example of what the auction results would look like. If you guys want to learn about what all this stuff means, competitive, not competitive, and all that stuff is, I am more than happy to explain it to you. Message me directly. I don't want to bore you with this stuff, nor do I want to get in depth of this. But for example, here are the primary dealers. Here are the direct bidders and the indirect bidders. Now, when we talk about primary dealers, can you guys can anyone figure out what a primary dealer is? If you guys had to guess, anyone? You get extra points for participation. Primary dealers are people like J.P. Morgan, Morgan Stanley, SocGen, UBS, the biggest banks, and the biggest institutional holders are known as primary dealers. Not everyone is a primary dealer. There are currently, I believe, only 20 primary dealers. How many primary dealers are there? There are currently 23 primary dealers. Okay? Just so you are aware, Ray Pitts was the primary dealer at First Boston. The guy that came and spoke to us that you met. Tom Layton was a primary dealer, both at UBS and at SocGen. So these guys have a direct line to the Fed. Does that make any sense? So remember, the primary dealers are the biggest bond dealers in the market. And the biggest primary dealers are the big boys in Wall Street. And those guys are what again, forgive me for being vulgar, they call themselves big dick swinging guys in Wall Street, right? Because they're swinging them big. They're swinging them big. They're not swinging a couple mil. They're swinging hundreds of millions of dollars, right? So that's why, and Bonk, who's in here, will tell you the guys that are most respected on Wall Street are the bond guys, right? Like Jeffrey Gonlock, who I'm not a big fan of. Every time there's the Fed talks, right? CNBC has him because Gonlock, even though he thinks that the world's going to end, and every single bond trader thinks that the world is burning every fucking day. There isn't one bond trader that's ever bullish. They're always bearish because that's how they are, you know. They're just super smart guys. That's why if you want to learn how to really trade, the best guys that can teach you are bond traders. Forget about all these stupid people that are telling you about futures and options and they're 23 years old. Forget those guys. Go listen to a 60 or listen to a 60, 70-year-old man that sounds like he smokes cigars and drinks whiskey all day. Seriously. Talk to you about trading and how you swing them, right? And then you'll really understand how the market.
I just got a
I
stray
really
out of
wish
nowhere.
I really wish that Bonk could leave and then come back in and we can unmute him because like his
It's
intro
not
would be
him.
so good.
It's his son.
Oh, it's a son.
Yeah.
Oh, my bad. Oh, I thought it was. Oh, no,
Yeah.
you're right.
Yeah.
Oh, yeah, I just got his message. Oh, what's up, Bonk's son? That's funny. Welcome, by the way. Any more questions? Bob is typing. Bob is the name of a guy who used to be one of my tennis coaches when I was a junior. Where do I find these old people? They're in Palm Beach, bro. Come to Palm Beach. I'll take you out. You'll meet them. They love to spend their money and go to strip clubs. Not that I would know.
God.
What? What?
What?
Judge me? Oh, who's this? There's people typing, and if anyone has any other questions, please feel free to ask. Can you go over some bond ETF tickers? Yes, I can. And we're going to do that after we do this because I'm going to do a very, very, very small Monday tickers. Are you okay with that, Kevin?
Yeah, that's fine, dude. Go ahead. Wait, so
Did you show?
JP, yeah, so answer for questions about the bonds first, so then I can end the recording and then
I
start
know.
the
I'm
new one.
just trying. I'm going through them.
Gotcha.
Sorry, I missed the last 4 minutes. I had to take a call. What happened? Nothing. Bing bong. Nothing important. What happens when the Fed fund rate starts crossing all of the bond lines you had us create on TV? Huh? Oh. Okay. Let me explain. So, this is the Fed fund. That's a really good question, by the way. I'm actually pretty. Great question. If you look at the piece of information that I provided you, the PDF, I stated that you have to look at the 2-year as the leading indicator of where the Fed needs to be. Do you remember when I said that? I'm Serv, you there? Okay. You know how when you hear people on TV, on Bloomberg or on CNBC talk about how, oh, they're going to have 2 rate cuts, they're going to have 3 rate cuts. Oh, the dot plot is showing 2. You ever heard those guys? I am Serv. Okay. It drives you kind of nuts because it feels like they're talking shit all the time, right? One day it's 2 rate cuts, one day is 1 rate cut, the other day is 3 rate cuts. You know, it's like, what kind of crack are they on, right? It's definitely not Palm Beach crack. So if anything that you take away from this is this, I want you to pay attention now, right? The 2-year is a function of what the front end of the bond market wants the Fed funds to be at. So right now, the 10-year and the 2-year are trading below the Fed funds market. That means that the Fed has to catch up to the bond market. Does that make any sense? The bond market is pushing the Fed to lower rates. Does that make any sense? I am Serv. And I am Serv, you're going to have to give me your real name because I'm not going to keep saying I'm Serv over and over again. Serv. Serv, bro. The 2 and the 10-year right now are trading below the Fed funds rate. So the bond market is pushing the Fed to lower rates because the bond market is always ahead of the Fed. Does it mean that the Fed is going to move with the bond market? No. But most, if not almost all of the time, the bond market is ahead of the Fed. So right now, the Fed is called what the term that is used to, wow, what am I saying? Learn how to speak, you idiot. What is currently happening at the moment is known as the Fed is behind. So the Fed has to catch up. So you have to think, if from here to here is how many points? And Serv, I want you to do the math right now. How many basis points are we from here to here? Okay, 1.25-ish. So let me ask you a question. Do you think that the Fed is going to wake up tomorrow and drop interest rates 1.25%? So let me ask you a question. How many cuts do you think the Fed would have to do in order to catch up to the 2-year? Be realistic. Do you think they're going to do 1, 2, or 3? 3, right? Realistically, it would be 3 because what would they do? They would drop it 0.5%, right? 0.25, 0.25. See what I'm saying? So the Fed is never going to have a chaotic a chaotic cut unless there's an emergency rate cut. And if that happens, that means that the world is ending. In all reality, right? There you go. It could be 2.5 exactly. So they have to do it in parts. So because the 2 is so far from the current Fed funds rate, you have to calculate how many cuts does Powell need to do at this point. Is he going to come in at 75? on 2, or is it more likely that he'll come in at 50 at 3, or is he going to come in at 25, 50, 50? What is he going to do? We don't know. But the reality is that it's not going to be 1. And now, because of the distance between the current Fed funds and the 2, you almost have to assume that it's going to be 3. And what a coincidence that Morgan Stanley came out and said that, no, I'm sorry, Goldman. Goldman came out today and said that their analysts are now saying that they predict that there's going to be 3 rate cuts this year instead of 2. Well, I mean, it doesn't take a genius to figure that out. Look at the spread between the 2 and the Fed. Does that make sense? So right now, the bond boys, the bond traders, literally the bond market is telling you, hey, asshole, we're probably going to have 3 cuts. That's what we want the Fed to do. Does it mean that it's going to happen? Jerome Powell doesn't have to do shit. He could just hang out there and do nothing. But the bond market is forcing its hand. It really is. It's forcing its hand. It's forcing the Fed's hand. It's telling the Fed, you suck balls. And you need to catch up to us. Because if not, we're going to keep going. And what happens if the bonds keep dropping? What do you think happens? Exit liquidity. You keep having sell-offs in the freaking stock market because everyone piles into bonds. Because I'd rather collect 3.8 on $10 million than put my money in freaking Palantir. I don't know why I said Palantir, but you know what I mean, guys, right? Because it doesn't make any sense. I'd rather just collect my money and collect interest rate. So what's going to happen? The market keeps dropping lower and lower and lower and lower and lower and lower and lower to the point where people are like, what's going on? And that is how recessions build themselves into from one thing to another. Recessions don't happen immediately. Recessions build. Think of them as a God, what is the name of this insect?
Mosquitoes.
The dung beetle. No, the dung beetle. It's that creepy looking thing that looks like a cockroach that apparently has a hard on for picking up poop and making it into a ball. It's literally
Why?
called the dung beetle.
Oh
And
my
it
God.
makes the ball bigger and bigger and bigger. You guys, everyone has seen this on National Geographic and on freaking Discovery Channel. It's the
Yes.
stupidest thing I've ever seen. I don't even know why, if God is real, why would he create that insect? Seriously, think about it. Like, that's like such a joke at life. Just like the platypus. It makes no sense. So, continuing. With that being said, if you right now, by having this chart on your screen, are able to understand that the Fed needs to catch up to the current bond market, what happens if the Fed doesn't cut? What happens if Powell decides that he's going to have a blast, right? And leave them uncut. What do you think is going to happen? More people pile into safety. More people pile into bonds. And where do you think they're getting that money from? You think they're getting it from underneath their couch or inside of the shoebox like us Latinos used to do? People start selling more of their equity positions. And they start putting it more into the bond market because they'd rather be safe than sorry. Because if you have money, you want to put your money to work. And if you're not making it work in the equity markets, where are you making it work, everyone? Everyone, if you type this out, you got special feet pics. We all know how much you love that, Tabitha. Yes, thank you. Thank you. So, do we understand collectively as a group? Wow, Tabitha, I wasn't expecting that coming from an accountant, but it makes sense now. Do we understand as a group how this functions? Do we understand as a group collectively how the Fed is behind. Do you guys understand now why it is that when Rick Santelli comes on TV screaming that the Fed is behind, why it makes sense?
Somebody's going to have to start raising money for us.
Do we understand why when this guy goes crazy on TV,
The government should spend $1 trillion an hour because we'll get 1.5 trillion back.
why it makes sense now? So if we understand this concept and we know that the Fed has to catch up to the bond market, let me ask you a question. Who do you think is forcing the hand of the Fed? Do you think it's the equity traders, those fucking peasants? Or do you think it's the 70-year-old, 60-year-old cigar smoking, woman strip club loving scotch drinkers that are primary dealers that are telling Jerome Powell that if he doesn't fucking push rates down, that they're just gonna keep selling? It's a fascinating world, by the way, guys. The bond market is crazy interesting because once you figure it out, you don't even have to be an investor in it. You don't. You don't have to do shit in the bond market at that point. But you know what? It tells you what not to do. Let me ask you a question, guys. Does it feel like the right time to start buying Tesla? Does it feel like the right time to start putting your money to work on these risky assets right now, today? Right now, today, right now, right now. Why not? Why not? Give me the answer.
Why do you keep playing that? So that was you earlier? That's crazy. By the way, all this,
Why is it not?
God.
Why is it not? Guys, very, 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 very easy question to answer. Why is it not a smart time to start putting money to risk? You're very close, Darlenem316. Darlene?
Darlene,
Darlene?
bro. Darlene.
Oh shit, my bad. Why am I reading it like a Latino then? My bad. Because we have reciprocal tariffs happening on April 2nd, guys. We don't know what's going to happen. So what happens on April 2nd, the day after my birthday, tomorrow? Happy birthday to me, happy 42. What happens if Orange Man, who I voted for, goes nuts? It really does goes nuts. Do you think that people are gonna exit the stock market, or do you think that they're gonna go and buy Tesla at 259.16, which is already down? I'm sorry, 1.25%. Well, it was because the market just closed. 1.25% in the after hours. Why do you think the stock market is selling off? Do you think it's selling off because, oh no, because Tesla's overvalued? Oh my God. Or it's because Orange Man has reciprocal tariffs happening on April 2nd? Do you think that anybody with a brain wants to hold high beta risk assets going into Jolts tomorrow,
Oh,
which is at 8:30?
I think MSTR is great here as a buy. It's better than bonds.
What's tomorrow? You're an idiot. You know that? What do we have tomorrow? We have at 8:55 the Red Book. At 8:45. Wow, this is all happening on the day of my birthday? Damn. At 8:45, S&P Manufacturing PMI. We have Jolts at 10. We have ISM at 10. We have ISM Manufacturing Prices Paid at 10. We have the Employment Index at 10. We have Construction Spending at 10. And then we have New Orders at 10. Who is the psychopath that's sitting here thinking, fuck, bro, what a great idea for me to buy Tesla, bro. I'm gonna buy it for this. I'm gonna buy weekly expirations because look at me. I'm super cool guy. I'm gonna see what happens tomorrow for Jolts, and I'm also gonna hold them going into reciprocal tariffs. Oh, look at me. I'm super sexy. I wear white pants and pink shirts. I used to, by the way, I used to back in the day. Why risk that? You wouldn't be doing that because you're not stupid, right? You want to wait for all of this noise to go through. You want to wait for everything to settle, for the dust, for everything to be like we say in Spanish, tranquilito, chill. Because we don't know if some dude that has who knows how many shares of Tesla, who might be the biggest baller that you've never heard of, who's some guy named Steve that lives in Romania, who dumps all of his Tesla shares, which account for who knows how many hundreds of millions of dollars, and decides that it's gonna be fun to call his primary dealer at JP Morgan and say, hey, Mikey, by the way, I want the 2-year right now. And then he's got to go and he's got to find a 2-year buyer. He's got to find a seller. It's not like he's got a shitload of 100 million in 2 years laying around in his pocket. He's got to go find a guy that's going to sell it to him. And then the word's going to spread that there's a buyer at the 2-year at 388 and he's buying 100 milli. And the guy is then going to say, yo, I got you. I got you. I'll cover you. Boom. He sells. You don't think that that guy's going to be like, yo, Mikey has a buyer at 100 mil at 3.8 on the 2. And then the guy at UBS that sold to him just made a bag, right? And then he told his buddy, and then everyone starts talking. Now everybody says, what does this guy know? And then yields start to drop and they start to tank, which is great if you were a buyer at 388. Because if you were a buyer of the 2 at 388 and it dumps to 354, you're making a shitload of money. For the next bond class that I'll give, I'll explain to you how you make money on the ticks, which is another can of worms. Does this stuff make sense, guys? The only reason I'm not responding is because I just want to see if people get this. Okay, cool. I'm gonna wrap it up here for the bond market and for an introduction into bonds, because I think that this was a lot of information to take in. I know Javi likes the way I said that, take in, right? Nobody? No one? Okay. To absorb this information. 2 hours or an hour and a half is a lot of talking about material that is new to you. Now that we have an introduction to this, and as I mentioned, if you guys want to learn more about this, you guys can add me as a friend, send me a message, and I'm happy to reference you some more material. Or if we get enough of a positive response to this, we can do another session where we go more from an beginners into an intermediate session. And if you guys are good enough, you're all good little boys and girls, I might even invite Tom Layton to be a speaker here, which would be really cool. And if you guys really want, I can invite the legend himself back, Mr. Ray Pitts, and he can come and give us a hands-on class on how the bond. I hate you, sir. You just made me say mon. How the bond market works. And if you guys want, which would be even cooler, I can try to schedule something where I have Leighton and Pitts together in a class, which would be really, really cool. Instead of at the bar where I have to listen to them talk about the old days and trying to hit on chicks that are like, instead of 70, 50, which is kind of weird. So I try to make this entertaining, guys. I try to, I want to be boring and talk about taxes. Right, Tabitha? We don't want to talk about taxes, do we? Class number 3, we all meet at the strip club and smoke cigars. Wow! Wow! These are the kind of people in this server. Wow. Wow. Incredible. Incredible. For you guys that are on Twitter that aren't here on watching these the Discord conversation, God bless you guys. I hope I've been entertaining along with Kevin, and please follow us on Twitter. I'm trying to become a bit of a Twitterite. Is that like a socialite, but on Twitter? I don't know. Whatever. Just go with the flow.
That's the term you ended up choosing?
What else am I gonna call it? You want me to say a Twitter slut? Is that what you want me to say?
No, I was gonna
Please
say
follow me.
Twitter famous.
All right, guys. So I'm going to conclude my session on the bond market. And as you can see, I have an incredible personality. Outside of the fact that I'm super good looking. I'm going to try to keep this entertaining. And the reason I try to keep it entertaining is because this is a very boring subject, which can be overwhelming at times, and a lot of people don't understand it. But I try my best to explain it like I would to a third grader. Most third graders are smarter than me, especially the ones in Palm Beach, but that's because they were born thinking that they hit home runs when in reality they're just on third base. Okay? So, this concludes the bond session. Not bondage session. Anyone? Nobody. Really? Nobody? All right, cool. Thank you for attending the bond session class. And now we move on to everyone's favorite part,